What's up, traders? It's your boy, Mr. Cosmic at the Cosmic Training Academy, where we train, travel, and trade. And I wanted to talk to you guys about dividend investing in stocks. Okay, so when you're investing in dividend paying stocks, avoid these common mistakes because there's a lot of mistakes that people make, but they don't tell you. And they're always trying to tell you guys to go buy these stocks just because of this or just because of that. But this is the first thing you need to understand: do not chase high yield stocks. Just because the dividend is paying out 10% doesn't mean that that stock is going to be good. Okay? A high dividend yield could be a sign that that stock is going to be falling. And that's that payout that when it gets too high at 20%, 15% of these high percentages, usually that's a spelling of disaster. And all it takes is for you to pay attention and you'll be losing all of your investment capital on that stock because it usually is doing a fall. One of the easiest way to determine that is open up your time schedule at the bottom and look for the year to date or the last 2 years or last 3 years and watch what the stock has been doing. If the stock has been going in an upward trajectory over the last 3 years, that's probably a good paying stock. Some of the best stocks to go with are some that have been paying out for many years. So take a look at that because sometimes those stocks are really unstable. Second, listen, don't ignore the payout ratios. Okay, if a company is paying out most of its earnings in as a dividend, meaning all the money that's coming in that is usually paying out, is probably struggling to maintain payouts during downturns. So a sustainable payout ratio is usually somewhere around 60 to 70%. So you want to look for payout ratios around 60 to 70%. That just depends on the kind of industry that we in. Third, don't overlook dividend growth again, but a stagnant yield. Okay, so keep an eye on that. So just because a company, if the company has increasing dividends, it's often better long-term investment than a one that has a high but a stagnant yield. So just look at that. Make sure that the company is growing. Okay. Another thing, avoid companies with weak financials. You gotta look at the revenue trends. Look at the debt levels, the cash flow. That ensures that a company can sustain its dividends because if the company ain't making money, then it's probably not going to be able to keep on paying out dividends. Okay? So fifth, don't forget about diversification. Relying on in one sector, that's going to get you in trouble. Just because you think in tech is going to be going to the, don't rely on tech. Where is anything about automotive? What about healthcare industry? You see what I'm saying? So take a look at all the different sectors and try to diversify. That's one of the number one rules to be an investor. Always diversify your portfolio. Never be in one sector. Never just be in healthcare and say it's going to be. Never just be in tech. You understand what I'm saying? Never just be in automotive. Never just be in trade. You understand what I'm saying? So always diversify and have a portfolio that's filled with multiple different industries. Okay, textiles, commercial goods, automotive, uh, planes, airplanes, so on and so forth, travel, industry. There's so many different things that you can do. Finally, don't ignore taxes. Different dividends have a different tax treatments. Okay, some companies you might notice they don't hardly pay any taxes. That's a good indicator that they're gonna have more money in their pocket to be able to pay out in dividends. Okay, especially if you're investing internationally. Okay, um, so if you're looking for good stocks, you have to look for ones that have good long-term growth. You want to look at certain companies that might not be popular. It's another thing that keep in mind. Some companies that will pay out a long extended dividend payout may not be the popular ones politically right now. So that's something to consider. All in all, guys, if you want to start building a good dividend portfolio, okay, do not go by anything people are telling you just because the dividends pay out well right now. You have to look at the fundamentals of the company. You have to pay attention to all of these rules about the company and how its potential to survive over a long period of time. And try not to deal with anything new. This is just for educational purpose only, but try to avoid new companies and look for long-term, older, more established companies that have been paying out dividends. And many people have different terms for these kind of companies, dividend royalty, it's just all these different kind of names. So that's what you want to do. You want to look for ones that have been paying for a long time. Maybe airline companies that have been paying dividends out for a long period of time. maybe healthcare industry companies that have been paying out dividends for 10, 15, 20 years. But not only have they been paying them out, but have been paying it and increasing them. So the dividends were paying out 10 years ago at 3% dividend yield, but now here 10 years later, they're paying out 5% dividend yield. This means it's been doing a continuous growth. And that's what you really want. You don't want a company that was paying 20 3 years ago, but now they're paying 10 now. Okay? So pay attention to that. It's your boy, Mr. Cosmic. I hope I answered any questions. Go to my website, www.cosmictrainingacademy.com. Cosmictrainingacademy.com is usually in the bio, somewhere on here. Look it up. I do private classes. I do mentorship. I'll teach you how to trade. If you want to travel and trade, or just want to learn how to trade, and you need somebody to take you by the hand and do some beginning courses or advanced courses, we also teach options trading. We got your back. Get at me. I got you. Mr. Cosmic, I'm out. See you.